Warren Buffett, the guru of finance and arguably the best investor ever, has stated, "We don't have to be smarter than the rest, we have to be more disciplined than the rest." This is even more important in times of market volatility. This was the worst week in stocks since 2008. The last time the Dow Jones Industrial Average Index was below 25,000 was June 3rd, 2019. It can be easy to feel overwhelmed by the relentless stream of market news. The media tries to use data and headlines presented as impactful to our financial well-being to elicit an emotional response. It can be difficult to ignore. When market uncertainty looms large in media headlines, like it currently is with regards to coronavirus, it is difficult to maintain perspective on what constitutes a normal level of equity volatility. In this video, I'm going to review the history of market volatility and compare it to today. Are we in unprecedented territory, or have we seen this before? I'll then show how the market has reacted so far to coronavirus and compare it to how it's reacted to other similar viruses. We can use historical data from similar outbreaks to predict how the market might react this time. Finally, I'll give you recommendations on how to position your portfolio to weather the coronavirus storm as best as possible. In recent days, the market volatility has resulted in renewed anxiety for many investors. While it may be difficult to remain calm during a substantial market decline, it is important to remember that volatility is a normal part of investing. Stock market declines are the last thing we as investors want to experience, but they are an inevitable part of investing. In the midst of a decline, it is impossible to tell the difference between a slight dip and a more prolonged correction. For long-term investors, reacting emotionally to volatile markets may actually be more detrimental to portfolio performance than the drawdown itself. This is because some investors will get so concerned with strong downward market movement, expecting it to be the next big correction, that they sell out. The majority of the time, the next big market correction does not come and the market recovers. By the time the investor feels comfortable investing again, they have locked in the losses and missed the majority of the rebound. When you try to time the markets, you have to be right twice. You have to be right on the way out, but you also have to be able to time the market bottom to get back in. This is incredibly difficult to do, and no one has been able to consistently do it. For perspective, on average from 1949 to 2018, the S&P 500 index has averaged about a 5% or more decline 3 times per year, a 10% or more decline about once per year, a 15% or more decline about once every 4 years, and a 20% or more decline every 7 years. Our current market decline is around 10.5% to 11%, so we're right in line with historical averages. These statistics remind us that while no one can consistently predict when market declines will happen, markets have historically been very resilient. Even with the sometimes large market corrections every few years, the markets have continued to increase in value by 10% per year on average since the early 1900s. We cannot predict how long a decline will last, and no one can consistently predict the right time to get in or out of the market. It is important to stay disciplined and in these situations not react to short-term volatility. You as an investor need to focus on areas of investing you can control. You can't control which way the markets move or when they will increase or decline, but you can control your discipline to stay invested when the markets are volatile, and you can keep your portfolio diversified so that you participate in all areas of the market. Diversification is the single best way to reduce your portfolio's risk while not sacrificing potential returns. This chart shows both the calendar year returns for the S&P 500 index since 1980, as well as the largest inter-year declines that occurred each year. This can get a little confusing, so let me explain. The gray bar is the annual performance of the S&P 500, and the red dot is the largest inter-year decline. Using 2019 as an example, the S&P 500 finished the year up 29%, but at some point during the year, there was a 7% correction. The most impactful year to me is 2009. The S&P 500 index had a calendar year return of positive 23%, even though the largest intra-year decline was negative 28%. That was from January 7th to March 9th. It was important to stay invested in 2009. If an investor reacted to market volatility early in the year and sold out, they would have locked in the losses and missed out on all of the upside. During this entire period, from 1980 through 2019, the the average intra-year decline was about 14%. Half of the years observed had declines of 10% or more, and around a third had declines of more than 15%. Despite the substantial intra-year drops, the annual returns were positive in 31 out of the 40 years. This goes to show just how common market declines are and how difficult it is to determine whether a large intra-year decline will result in negative returns over the entire year. David Booth, co-founder of the mutual fund company Dimensional Fund Advisors, and the man that the University of Chicago Booth School of Management is named after. This guy is a financial wizard. He wrote this last year. Volatility is a normal part of investing. We all know that markets go up and down, so we can be disappointed by downturns, but we shouldn't be surprised by them. Most importantly, for long-term investors, reacting emotionally to recent market volatility can be more detrimental to portfolio performance than the drawdown itself. He's pointing out that we must stay disciplined and remain invested. This is historically the only surefire way to make money in the investment markets consistently. So, how has the market reacted to other historical crises? Are we in unprecedented territory, or have we seen this before? This chart shows performance of a balanced investment strategy following a few crises in recent history. Each crisis is labeled with the month and year that it occurred or peaked. The subsequent 1, 3, and 5-year annualized returns start from the first day of the month following each crisis. Although a global investment strategy would have suffered losses immediately following most of these events, the financial markets recovered over time, as indicated by the positive 5-year cumulative returns, shown by the green bars. So, how does the market's response to coronavirus compare to other disease outbreaks in recent history? This chart shows the performance of the S&P 500 during several different viruses. This is as of Friday, February 28th. As you can see, the S&P 500 has already declined 10.63% due to coronavirus fears. This is close to the 12.8 and 12.9% the market declined for SARS and Zika respectively. Although the number of trading days is still less than most other epidemics. Does this mean that we are close to the bottom already? Maybe, maybe not. No one knows. But based on history, I would be surprised if the market continued to decline much more than it did for these other similar epidemics. The good news is that historically stocks rebound quickly from disease outbreaks. This chart shows the 1 and 6 month returns of the MSCI World Index following several other epidemics. As you can see, most recovered within 6 months, some with extreme positive performance. While I don't expect a 40% return over the next 6 months like swine flu experienced, somewhere close to the average 6-month return of 8.5% wouldn't surprise me. But, as I've said earlier, I don't know what is going to happen in the markets. We can look at historical performance such as this to get an idea of how markets have performed previously, but there's no guarantee that they will follow suit this time. I feel like the market is overreacting to the coronavirus epidemic. About 87,000 cases have been confirmed globally, with 3,000 deaths due to coronavirus. While this is awful, the market is reacting more to the uncertainty surrounding the disease rather than the actual effect it has had. Of the 87,000 cases reported, over 42,000 have already recovered. I've included this link in the description below if you'd like to live track the global cases. As a comparison, from October 2019 through February 2020, so the last 5 months, at least 12,000 people have died from the flu, and that number may be as high as 30,000. It is estimated that up to 31 million Americans have caught the flu this season. The CDC estimates that somewhere between 12,000 and 61,000 deaths in the United States each year can be attributed to the flu. Globally, the World Health Organization estimates that the flu kills 290,000 to 650,000 people each year. The uncertainty surrounding the coronavirus has caused it to affect the investment markets in this way. We are not as concerned with the flu because it is much more familiar to us. It also helps that there are vaccines and antiviral medications to help deal with the flu. These make us feel like it is more under control, even though they are not 100% effective. The markets may have further to fall, or they may begin recovery tomorrow. No one knows. Anyone trying to tell you differently is simply trying to elicit a response or is buying into what they hear from the media. But Diversification and a long-term perspective can help investors use discipline to ride out the storm. The best way for you to reach your goals is to stay invested. Trust me, I know it's tough. It's tough for me too. But as Baron Rothschild said, the time to buy is when there's blood in the streets. So, what should you do? How should you position your portfolio for the best results in the current market environment? If you've made it this far, the answer should be fairly obvious, but it's easier said than done. Stay invested, or even better, add to your investments. Remain diversified and don't try to time the market. This final chart shows the annualized compound return of the S&P 500 index going back to 1990. It illustrates the impact of missing out on just a few days of strong returns. The bars represent the hypothetical growth of $1,000 based on investor behavior. The data shows that being on the sidelines for only a few of the best single days in the market would have resulted in substantially lower returns than the total period had to offer. The S&P 500's return, if you stayed fully invested over this period, is 9.29%. $1,000 invested would have grown to $13,137. But if you missed the single best day in the market, then suddenly your return dropped to 8.87%, and $1,000 only grew to $11,773. If you have really terrible timing and you missed the 5 best days, then your return dropped to 7.75%, and $1,000 only grew to $8,715. By the time you miss the 25 best days, you are barely better than investing in 30-day US Treasury bills, which are considered the risk-free rate of return. While market volatility can be nerve-wracking for investors, reacting emotionally and changing long-term investment strategies in response to short-term declines could prove more harmful than helpful. Adhering to a prudent investment plan, determined upon prior to periods of volatility, will help you remain calm during periods of short-term uncertainty. So, how are you reacting to market volatility? What are your biggest concerns? Let me know in the comments below. If you found this video helpful, please like and subscribe. Now may end up being one of the best times to invest. You can use the link below to open a Webull account and receive 2 free stocks valued up to $1,400 when you fund it with at least $100. And you can earn an additional stock when opening a Robinhood account with the link below. I will also receive free stocks when you use the links below. Good luck and have a great day. Don't worry about the markets. Invest for the long term. The world is not going to end. This too shall pass. Keep your heads up. The markets will rebound eventually, as they always have before.